Bitfarms Ltd is currently trading at 6.46 Canadian dollars, surging 11.00% on the day, a move of 64 cents. Now, the immediate reaction, the expectation, is to look at the price of Bitcoin and assume this is just the tide lifting all crypto-related boats. But this double-digit pop is pointing to something much more specific. This isn't just a simple echo of the underlying asset. This is the market beginning to grapple with the reality of Bitfarms' operational leverage and its aggressive positioning ahead of an event that could wipe out its competition. While everyone is watching the spot price of BTC, the real story is that the market is suddenly re-evaluating Bitfarms' cost per coin and its race to scale. And that 11% move is the first sign that the narrative is shifting from a simple proxy to an industrial-scale survivor. Most investors, particularly those new to online investing, see miners like Bitfarms as a straightforward, high-beta play. The common belief is that it's just a leveraged bet on Bitcoin. If Bitcoin goes up 3%, stocks like BITF are expected to go up 8 or 10%. If Bitcoin falls, they collapse. It's the kind of holding you might buy on the Robinhood app for quick speculative exposure, much in the same way you'd grab some Tesla stock for a momentum play on EVs or Nvidia stock for the AI narrative. For many using basic investing sites, this is the beginning and the end of the analysis. It's an asset to trade, not a business to analyze. It's the high-risk component you throw into a self-investing account to try and catch a wave, completely separate from a diversified, managed product like a Schwab Intelligent Portfolios account. But that perspective is dangerously simplistic and entirely misses the brutal industrial competition happening beneath the surface. This 11% surge we're seeing today, especially if it's on heavy volume, suggests a fundamental re-rating is underway. This isn't just about the price of Bitcoin, it's about the cost to create one. Bitfarms isn't a digital wallet, it's a globally diversified network of data centers in a life-or-death race for the cheapest possible electricity. The reality is that this company's future is not decided by Bitcoin's price alone, but by its all-in mining cost. While the casual trader on Robinhood is just watching the crypto ticker, sophisticated funds using platforms like Interactive Brokers are modeling Bitfarms' power contracts in Argentina, their fleet efficiency in Canada, and their new site developments in Paraguay. They are analyzing hash rates, operational uptime, and balance sheet resilience. This 11% move isn't just a speculative ripple. It's likely driven by new data or confidence that Bitfarms' cost structure is improving faster than its rivals, positioning it as a definitive survivor and potential thriver after the next Bitcoin halving cuts mining rewards in half. That is the real investment narrative, and it's far more complex than the proxy expectation. Let's dissect this 11% move. We need to look at the volume. Is it heavy? If so, it suggests this isn't just retail enthusiasm from SoFi investing, it implies institutional buying. This kind of move often indicates that funds are taking a serious position. This stock is, of course, incredibly sensitive to macro pressures, but it's not just interest rates, it's energy prices. A dip in natural gas futures or news of a new favorable power purchase agreement can dramatically alter the company's future cash flow projections. This is what professional traders on the Interactive Brokers trading platform are watching. They're not just doing SoFi active investing based on a headline, they're analyzing power grids. This is also a stock whipsawed by regulatory sentiment. Any hint of a friendlier government stance on mining, or conversely, a new environmental tax, can send it flying. For those looking for investing help, this is one of the most difficult sectors to navigate because its inputs are so varied. It's part commodity, part tech, and part geopolitical chess. When you look at the options available to an investor, the contrast is clear. Someone using Fidelity, for instance, has a vast universe of choices. They might be looking at Fidelity ETFs that bundle various tech or energy companies, or perhaps stable Fidelity mutual funds for a core holding. A Fidelity brokerage account gives you the freedom to make your own choices, to buy Apple stock for its ecosystem, or to take a shot on BITF for its volatility. But placing a trade for Bitfarms is a conscious decision to extreme risk. This is not a set-it-and-forget-it holding you park in your Fidelity IRAs and check in 30 years. The Fidelity trading platform and its associated Fidelity mobile app make it incredibly easy to get in and out, which itself contributes to the stock's wild intraday swings. But the ease of the trade, a feature common to Fidelity, Robinhood, and SoFi, masks the extreme complexity of the underlying business. So, what does Bitfarms actually do? On the surface, it's straightforward. They run massive warehouses filled with specialized computers, known as ASICs, that operate 24/7. These computers guess the answer to a complex mathematical problem. The first one to get it right mines the next block and is rewarded with a set amount of new Bitcoin. Bitfarms is quite literally a Bitcoin factory. Its entire business model rests on one simple, brutal equation. Is the market value of the Bitcoin they create greater than the total cost of the electricity, hardware, and labor needed to create it? This is why their expansion into places like Argentina and Paraguay was so critical. It was a global hunt for the world's cheapest, most abundant power. Furthermore, Bitfarms often holds a significant portion of the Bitcoin it mines on its balance sheet. This HODL strategy creates a double leveraged effect. Its core operations are profitable, and its corporate treasury, its assets, appreciates if Bitcoin's price rises. This is why many investing sites flag it as a top performer during bull markets and a catastrophic loser during crypto winters. Looking at its history, the Bitfarms chart is a classic boom and bust story. It has delivered astronomical life-changing gains and has also experienced gut-wrenching 90+% drawdowns. This history is precisely what feeds the simple proxy expectation. Many investors who tried Robinhood stock trading during the last peak got severely burned on miners, watching their Robinhood investments evaporate. This has, justifiably, created a show-me attitude in the market. The company has had to navigate extreme capital market cycles, manage a significant debt load, and deal with the operational headaches of running data centers across multiple continents. This isn't a clean, simple Fidelity wealth management product. This is the raw, sharp edge of self-investing. You either need to be an expert or be prepared for a ride that a SoFi robo-advisor would never ever recommend. This is a pure SoFi active investing for those with a high tolerance for risk. Everything now points to the future, and that future is defined by one event, the Bitcoin halving. This is a pre-programmed update to the Bitcoin code that cuts the reward from mining a block in half. Overnight, Bitfarms' revenue, in Bitcoin terms, will be sliced. This is the ultimate stress test. The expectation is that this event will be an apocalypse for inefficient miners, crushing their margins and forcing them into bankruptcy. But the reality is that it's a catalyst for intense consolidation. Only the miners with the absolute lowest cost of production will survive. If Bitfarms has managed its fleet efficiency and, most importantly, its power costs correctly, it will not only survive, it will thrive as its competition literally unplugs. Their share of the total network hash rate could then increase dramatically, allowing them to mine more Bitcoin in the long run, even as the per-block reward falls. This is the entire bull case. The bear case is that their debt is too much, energy costs spike, and the price of Bitcoin doesn't rise fast enough post-halving to offset the reward cut. This would put them in existential jeopardy. The accessibility of this trade is a major factor in its volatility. The appeal of Robinhood fractional shares means you don't even need the 6.46 CAD to get get in. You can buy $1 worth, which pulls in a massive retail audience. This is a very different type of online investment than building a long-term position in a blue chip. For more sophisticated traders, platforms like Interactive Brokers offer the tools to actually trade this narrative. On the Interactive Brokers platform, you can analyze the options chain, short the stock, or set complex conditional orders based on the price of Bitcoin futures. The Interactive Brokers fees are structured for active traders who are making these calculations, not for passive holders. A trader with an Interactive Brokers account is likely viewing BITF as a component in a complex global macro strategy, weighing it against Nvidia stock for compute exposure or Tesla stock for high beta growth. This is a world away from a standard individual brokerage account where you simply invest online. Even within SoFi, which offers SoFi stocks and SoFi ETFs on its SoFi trading platform, BITF stands out as a high-risk outlier. This brings me to a